Hi, I'm Brandon from Achievable. Before we get started, just a quick plug for our learning program. Achievable offers courses on all major FINRA and NASAA exams, including the SIE Series 6, 7, 63, 65, and 66 exams. This is a great learning program if you're looking for easy to understand, fun, and engaging material that uses technology to help you pass. I wrote the course content exclusively for Achievable, which includes tons of real-world examples, videos just like this one on dozens of key topics, a built-in study planner, hundreds of chapter review questions, and unlimited practice exams. In short, if you love these videos, then you will love what we have on Achievable. Our courses are competitively priced, and you can try them out for free to see if our style is the right fit for you. Follow the links below in the description to get started. Let's talk a little bit about what an option-based income strategy is. Now, if we think about the term income, I would think, well, income means we're increasing our return specifically from the sale of an option. Sell an option, collect a premium, increases the amount of income we make overall. Keep in mind, there's only one way to make money on a premium of an option, and that's to sell it. And that's something you'll see when we look at both income strategies here. In both scenarios, we're selling an option technically against a stock position. The first specific income strategy we'll talk about is long stock, short call together as one strategy, which we also refer to as a covered call. Similar to hedging strategies, we will think about the stock being our primary focus with income strategies as well. I'm bullish when I'm long stock. I want the market price to rise, and the higher the market price goes, the better. If I buy stock at 60, I want it to go up to 100, 200, 300, so forth. And I don't want the market to go down. If I buy stock at 60, worst case scenario, market price goes all the way down to zero, and I lose my entire investment. So let's keep that in mind as we now shift over to the short call. A short call is an option that gives the investor the obligation to sell 100 shares of stock at the fixed strike price. So if we get exercised in that short call, we're going to be forced to sell the stock that we own at whatever the strike price is. There's a pro and a con here to be aware of. The pro to selling the call is that's money in our pocket. Sell the call, immediately make a premium, immediately increase your return just by doing so. But the con, the drawback of this strategy, is if we get exercised, we're going to have to sell our stock and we won't have much to say. So for example, if I buy stock at 60, and let's say that the highest price I think the stock will go to in the next 9 months will be 65. So I go short a 65 call. What does this mean? Before we think about that, let's reset on call up, put down. Call up, if the market price rises above the strike price of a call up, the call will be exercised. So that tells us here, if the market price goes above 65, we're going to be forced to sell our stock, and that'll be the end of the story. And that's the drawback to a short call. If the market price were to rise, say, to 100, it doesn't really matter what happens above 65. As soon as the market price goes above 65, we're technically in exercise territory where we can assume that whoever owns the call that we sold it to, they're probably going to exercise soon. And if the market price were to rise to 100, it's just a matter of time. That exercise is coming. And that could be a problem. Now think about the problem there. If we buy stock at 60 and get forced to sell our stock at 65, we're making money, right? That's a profit. That's $5 per share that we make on just buying at 60 and selling at 65, plus whatever the premium of the option is. That's money in our pocket. But the drawback here is opportunity cost. If we hadn't sold the call, if the market price rises to 100, that's a ton of money that we can make on the stock position. Buy the stock at 60, sell the stock at 100. That's a huge gain there. And that's the risk of an income strategy, is if the market goes in the direction that your stock position is hoping for, in this case up, we can lose out on upside potential just by the virtue of our option being exercised. Now, if the market price were to fall, let's say fall significantly down to zero, the short call is out the money. Remember, call up. Calls only get exercised if the market price rises. So again, if the market price falls, that call will expire, but at least we keep the premium. That call will not act as protection for us. It only gets exercised if the market price rises. Now, last thing, the name, covered call. We call it a covered call because the risk of the short call is covered just by us owning the stock. If you know your single leg strategies really well, you understand how risky a short call position can be. If a short call is all by itself, let's say a short 65 call is there with no protection or it's not covered by anything, if the market price were to rise to 1,000, get exercised, you'd have to go to the market, buy stock at 1,000, sell the stock at the strike price being 65. That'd be a big problem. But by virtue of owning the stock, don't have to worry about that. The long stock protects the risk of the short call position. But keep in mind, the term covered call, does that mean you can't lose money at all? No. You can actually lose a significant amount of money. Again, if the market price were to fall all the way down to zero, you lose all the money in the stock position. Yeah, you keep the premium, which probably is going to be somewhat small. Keep the premium on the short call, but you still can lose significant amount of money in the long stock position. The other type of income strategy is our short stock, short put. When we combine those together, that is what we refer to as a covered put. We will again think about things primarily through the stock position. So short stock. Short stock means I've borrowed stock from my broker-dealer, sold that stock immediately, hope the market price falls so that I can buy back at a lower price. Let's say we sell short at 40, market price falls all the way down to zero, we're able to buy back stock for nothing, give those shares back to our broker-dealer, great. But remember, there's a huge potential problem with a short stock position. If the market price were to rise significantly, goes up to 500, 600, 700, the higher the market price goes, the more expensive it is to buy back that stock. So short stock technically has an unlimited risk potential. Once we pair our short stock position with a short put, again, we have a covered put. The short put gives the obligation to buy stock at the fixed strike price, at least until that option expires. Let's say, in our example here, that the furthest we think the stock price will fall in the next, let's say, 8 to 9 months is 30. So we go short a 30 put with our short stock position. Call up, put down. Put down, that means that put will only be exercised if the market price falls below the strike price. It's important to know that because we need to know when the option might work against us. Of course, by selling the option, that's going to put that premium right in the investor's pocket, so they'll make money just from that. Let's now think about things big picture. If the market price were to fall, let's say significantly, all the way down to zero, once the market price falls below 30, that short put goes in the money, put down, and will force the investor to buy back that stock at 30. So if the market price were to fall to zero, would the investor be super happy about that? Probably not. Because they know as soon as the market price falls below 30, that's the best case scenario. As long as I have this option here in place, best case scenario is I buy back the stock at 30, at least until the option expires. And then, yeah, if it were to expire, then maybe I'd hope the market continues to fall. But again, in this example, market price going down to zero, the investor would love to buy back their stock at nothing, but the short put will force them to buy back the stock at 30. If the market price were to rise instead, remember, our short stock position is not too fond of that happening because, hey, the higher the market price goes, the more expensive it is for us to buy back the stock. And in this case here, the higher the market price goes, the worse it gets, even with the short put. Remember, put down, that put only gets exercised if the market price were to fall. So when the market price rises, yeah, that put's going to expire. We do keep the premium if the market price rises, but the point is that the investor still has a limited risk potential with their short stock, short put income strategy. Now, some of you might be looking at the name, covered put. Covered. Doesn't covered mean no risk or lack of risk? Yes and no. A covered put means that the risk of a short put, which is the risk of the market price falling significantly, The risk of a short put is covered by virtue of owning a short stock position. Short puts, as individual standalone strategies, lose money when the market price falls. The further the market price goes, the more you lose if you're just short a put. With the short stock position, you have something together with that short put that will actually make money as the market price falls. So that's why we call it a covered put. The risk of the short put is covered by the short stock position, but it doesn't go the other way. The short stock does not have any protection other than the premium that the short put collects. So bottom line, be careful with that terminology, covered put. Covered puts are still subject to unlimited risk potential, not because of the risk of the put, but because of the risk of the short stock position. So overall, how do we summarize income strategies? Well, if you want to figure out the market sentiment for an income strategy, they're flat, neutral. Investors typically take part in income strategies when they think the market's not going anywhere for a short period of time. If I don't think the market's going anywhere in the next, let's say, several months, why not make a bet on that? I could sell a call against the long stock position or sell a put against the short stock position. And if the market price does stay relatively stable or flat, the option will just expire. And yeah, I didn't make or lose any money on my stock position, but I made a premium on the option that I sold. But keep in mind that these are not hedging strategies. Losses can be significant and even unlimited depending on which strategy you're looking at.